This is all part and parcel for why you're seeing de-dollarization. Holding your assets in dollars is the surest way to go broke in an inflationary environment. Dollar's already down 11% so far this year. And this is a trend that I think will continue not only just through de-dollarization, but also through the plans of this administration to have a weaker dollar with the intention of having it spur on manufacturing demand in this country, which is ultimately, I think, what they're saying they're trying to do. So, yes, in an odd sort of way, it will enhance de-dollarization. And even though it appears outwardly that there is independence, the folks that are being put on the board are anything but independent thinkers. They will toe the line with the current administration. So it's just smoke and mirrors once again.
In today's news recap, Chinese insurers put pressure on the gold market. Chinese insurance companies are about to detonate a bomb that could have a profound impact, especially on the gold market. This bomb was already set off in February 2025 when the Chinese government, through its Insurance Regulatory Authority, issued a new regulation requiring the country's large insurance companies to hold at least 1% of their assets in physical gold. 1% of assets may not sound like too much gold that now needs to be purchased by insurance companies. Initially, not all companies are affected, but only the country's largest insurers. However, this is only the first stage of a multi-stage plan. The next stages envision gradually increasing the number of insurance companies affected by the regulation so that eventually all insurers will be included. The percentage of managed funds that must be invested in physical gold is also expected to rise from 1 to 5% in the medium term. A massive rush from the Far East for the world's gold is slowly but surely brewing. The decision by the Chinese Insurance Regulatory Authority has far-reaching implications, as it will redirect billions of U.S. dollars, which have predominantly been invested in U.S. government bonds, into the gold market. The immediate consequences are already significant, but even more dangerous are the medium-term effects that this decision has or could still have. Since decisions of this magnitude in China are not made on a whim, but are approved by the highest authority, we are dealing here with another facet of China's strategy to detach itself from the U.S. dollar and the Western financial system. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
I mean, the deliveries on the COMEX are extraordinary, Elijah, as are the offtakes off the COMEX exchange, which are extraordinary. These are very, very much aberrations. They're anomalies. We don't see them very often, or never have until recently. And I remember talking with your dad in 2020 about all of a sudden all of these deliveries coming into COMEX. They've only increased 100-fold. But when you talk about trends, Saudi Arabia is now, to my mind, the third government next to China and Russia who are, well, maybe let's call it the fourth, India, China, Russia, and Saudi Arabia now. And again, these are all, these are members, whether admitted or not. Saudi Arabia is, in essence, in my mind, pretty darn close to a BRICS member in that they are a full participant in the M-Bridge technology. They are going to all of the BRICS meetings. They are very much have one foot in and one foot out to appease the West, but by all of their moves appear that they are going lockstep with the BRICS movement. They took a major stake in SLV, the silver ETF recently, and enough to demand physical delivery. Now, they haven't done it yet, but you have to have a certain amount, like it's a basket, huge amount, millions and millions and millions of dollars worth in order to be able to demand physical delivery. This is a privilege retail investors do not have. they will. I find it interesting. We've talked at length about China flying around the world and buying doré and concentrate directly from the miners in South America and Mexico. We've talked about India buying over 800 million ounces in the last 5 years. We've talked about Russia making it part of their national stockpile, which we'd never heard before from a government, and now Saudi Arabia is doing just that. And so when you realize that India, China, Saudi Arabia appear to be publicly accumulating silver under the guise of industrial uses, it's a lot more than industrial. Silver is really more strategic than it is industrial. You mentioned billionaires. David Bateman is the one that comes to mind. He came out recently and said, that just a 10% shift from gold to silver, where all the people investing in gold, if 10% moved it to silver, it would consume all newly mined silver globally. This is, implying a potential massive squeeze. He said, one billionaire won't do it, but 10 would, or a 10% shift out of gold into silver. When you see governments like Saudi Arabia come into the fray, you know that it's coming. I found it very interesting. One of the things that I talk about a lot when we talk about the public not holding any gold, very little. My standard phrase I copy from Rick Rule. He says, from Joe and Jane Sixpack to the Harvard Endowment Fund, the average of gold owned by the public and gold-related equities is 0.5%. Well, lo and behold, the Harvard Endowment Fund just bought $101.5 million in GLD recently. And so now you have all of these institutions jumping into accumulating precious metals. Now, these institutions, I don't know how much they understand the difference between GLD and the real thing, but you look at Bass, his last name is Bass, I forgot, Kyle Bass, I think is his name. When he was running the hedge fund, I think it was for the Texas the Texas Teachers Union, or it was a big fund for that. I believe that's what it was. It was a long time ago, maybe a decade ago, but he put all that money, like $1 billion into GLD, and they took possession of it as well. So I don't know if he intends to do this, or they intend to do this time, the Harvard Endowment Fund. But the very fact that they're buying $101.5 million in GLD tells you that gold and silver are becoming more mainstream, certainly more mainstream. And I think you'll see at this upper level on COMEX, sovereign wealth funds, endowments, that's one step away from the public, who is still kind of blissfully, whistling Dixie, not really understanding the significance of this. But the people who are very, very tied in to what's happening globally are making moves and standing for delivery. It's a big deal. To see the Harvard Endowment Fund jump into this degree is a very big deal.
In today's news recap, UBS, stay long silver, buy below this level. UBS urged investors to maintain long positions in silver and pointed to favorable entry levels after the metal's recent consolidation. Silver prices have recently consolidated around $38 per ounce, but UBS expects the metal to advance toward $42 to $44 in the coming quarters, provided the Federal Reserve resumes its rate-cutting cycle. The bank introduced its third quarter 2026 target with this note, rolling over forecasts and making incremental upward adjustments further out. Its projections for the fourth quarter of 2025 and the first quarter of 2026 remain at $42, while forecasts for the second and third quarters of 2026 have been raised to $44. We favor a long position in silver and would add to positions on pullbacks below $36 per ounce, strategists Dominic Schneider and Wayne Gordon wrote. The team notes that drivers behind the bullish case are unchanged. Expectations of the Fed gradually shifting rates to neutral, a softer U.S. dollar in the mid to high single-digit range, and eventually stronger economic growth supporting industrial demand should underpin the market. However, the strategists caution that near-term growth concerns may limit upside, given that more than half of silver demand comes from industrial applications. Historically, the gold-silver ratio at 89.7x could narrow to 75 to 80x if growth accelerates, UBS said. With its gold forecast at $3,700, This would imply silver prices in the $45 to $50 range, though the bank considers it premature to reflect such levels in official forecasts. Its long-term target of $44 already points in that direction. Now, we'll show you the best clips of the latest interviews, but first, smash the subscribe button and turn on notifications so you do not miss out on our recaps. And check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trading the gold-silver ratio and increase your ounces. With this easy-to-read book, you'll know everything you need to know to stack efficiently so you don't have to rely on market commentators. Enjoy the episode.
Powell has more or less waved the white flag, if you will, against the battle, with the battle against inflation, and confirmed that they will no longer aim for their silly inflation target of 2%. Shift away from these dovish policies tied to I guess you could say, trying to pretend that, inflation is under control. It's not under control, and I think really what they are looking forward to or trying to do is focus more on the labor numbers, which are ridiculous in and of themselves. When we saw, I don't know how many hundreds of thousands of jobs that were adjusted downward from May and June. And so in essence, it's a shift away from inflation expectations and now tying it directly to the labor market performance. I think what you can expect to see in that respect would be much higher inflation. And it's interesting that they're talking about lowering rates heading into what seems to be a very stagflationary environment where unemployment seems to be increasing. The numbers which we were told that represented strong labor numbers were a farce. And inflation really is far worse than what they are saying, as far as I'm concerned. You're talking, I don't know when the last time we've had a 2% monthly inflation number, and they'll never hit that target. So in essence, what you could expect would be much higher prices into a very weak economy. And, they talk about, this being a benefit for home prices as an example. Well, lowering rates isn't going to benefit new home buyers. It's only going to make the problem worse. That's what got us into this problem to begin with. So yeah, I think that the last thing really that this economy needs at this point, as far as I'm concerned, is lowering of interest rates, because it gets us right back into the same problem that we have been in all along, which is distortions of interest rates. The market should set the interest rate, not the bankers. And by allowing the bankers to do this, it's distorting asset prices. It's creating imbalances or misallocations between resource and capital. And this is the problem that we've seen over and over and over and over again, and that is not letting the market control the rate of interest and the cost of money, but thinking the bankers know best. They're late, and even doing it now at all, to me, is the wrong thing. This is the problem. We're boxed in, and they feel that they need to do this. But in essence, all we're going to do is distort things even worse. The rich are going to get richer as asset prices are going to go much higher. The economy is already slow. So for people who have already lost their job, or the lower income folks, are going to see much higher asset prices, or much higher prices in just the necessities that they need. So the wealthy get wealthier because they own assets, and the poor who don't own assets will find it harder to put food on the table, to drive to work. You're just going to see an uptick in inflation and an economy that is shedding jobs. The Bureau of Labor Statistics, the BLS, should just be called what it is: bullshit, BS. And the numbers that come out of there, whether it be unemployment or whether it be inflation, have misled the public for a very, very long time. And the numbers that they're telling us on inflation are actually much, much higher. You know this. Your dad knows this. We've talked about John Williams and shadow stats. He's been on your show, and he would tell us inflation's actually closer to 11%, not the 2.5%, almost 3%. The producer price index shot up last month, and again portraying higher and higher inflation. And really, this is going to light a fuse, if you will, under the costs of living expenses for the average American person, it's not going to do much to help the average American. What it will do is it'll benefit the upper 1% who have lots in the way of asset price.
What do you think of Schectman's take? Do you agree with him? Is the big reset a reality, or is it all just bollocks? Post in the comments section down below your honest opinion and share with the stackers your gold and silver price prediction. Now, check this video right here because it's a perfect fit for you, and I'll see you on the other side.